Welcome to the channel, Michael Snagget. I welcome you all to today's episode of Michael Snagget Financial Literacy Series. Today we have a very good and interesting topic to talk about. I guess you are ready for us to
Recording in
kickstart.
progress.
Yes, today you are welcome to Michael Snagget podcast, and my name is Michael. And today we are discussing investment for beginners. We are discussing investment for beginners, and I hope you are ready and prepared for this episode of our financial literacy series. That's what we are doing tonight. And if you have been telling yourself that I would start investing when I have more money, and I don't know or I don't have enough money yet, then this episode is for you because we are going back to the basics. We are going to start from the scratch. No jargon, no assumptions, just clear and honest guidelines that will be suitable for every beginner, anyone who is battling with where to invest, when to invest, how to invest, and everything, every little thing about investments. We are going to talk about it. I mean, from the basics, from the scratch, and then I hope that you are going to get a clearer understanding after this episode of our podcast. Yes. So let's zoom into action whilst we wait on others to join us live on Facebook and Zoom and YouTube as well. And it's going to be fantastic tonight. So we are starting right away and we are asking ourselves these basic questions that why do most people never start investment? Why do most people never start investing? What are the excuses? What are the causes? What are the things that come into people's way that prevent them from starting some kind of investment or some kind of, let's say, savings? I mean, from the start. Okay. So these are the various talking points that we can discuss as to the reasons why people do not even actually try to start investment at all. So the first reason is that people have I would wait till I have more money, I mean mindset. And that is a kind of a trap that people find themselves in. I would wait while or until I have money, enough money to start. People have the basic idea or the mindset that investment requires huge amounts of money. Investment requires large amounts of money. Investment requires a lot of capital to start. That is the kind of mindset that people have, kind of a trap, a net that people find themselves in. Okay. So, I mean, by the end of this episode, we are going to understand that investment in itself doesn't require that, I mean, mindset of thinking that people think you have to get enough money, you have to get large sum of money to start something. So that is about it. And again, there is also this fear within people that they are going to lose their money. All right. I mean, the risk surrounding investment. People think that investments is all about you going to lose your money or probably lose the value of your money. So even though this is valid, this reason or this mindset is kind of a valid reason, but that is not a valid reason in essence or in substance, okay? Because I mean it is a risk and return game, all right? It is a risk and return game, and it is a game of risk. No matter what, around the world, I mean in the world in which we live, there is risks everywhere. So it's a game of risk, and people normally don't understand this basic concept of risk, and that is why people fear that they are going to lose their money when they begin to invest. That is another reason. And then there is also a mindset of complexity. Like people think that investment is a kind of a complex game. It's a complex puzzle to unravel, and there's also a kind of reasons why people actually don't go near investment. They think the process that are involved, the I mean, the industry that the investment industry or the finance industry is kind of a complex thing, and people think I mean, let me sit my place, let me sit somewhere and then enjoy, let me be comfortable with the little that I have. I mean, the management system that I have, and I don't want to entangle myself in this kind of complexity game. Okay, so that is about one of the reasons why people also never even start to invest. And then another reason is that people think investment is for rich people. All right, I mean, it is for rich people myth. It's a myth, something that people have come to adopt in their mind, that I don't have money, it is for the rich people. They have the money to invest in companies, they have the money to invest in, I mean, stock exchanges, and I mean, all other reasons that they can give. But that is actually not entirely true. Okay, so that is why we are discussing investment for beginners for today. Okay, now, um, you having the decision to invest is a good idea, and then you not investing is also a decision. All right, so in both ways you have all taken a decision, but depending on where you are going to put your money or where you are going to use your money for will determine the final impact or the final result, um, of your decision or of your choice that you make. All right, so let's actually go into what investment is. What actually is investment? That is the basic question that we have to ask ourselves. What are the basic concepts when we are discussing investment? So let's talk about savings and investment. That is a, I mean, we can't discuss anything without talking about first savings and then understanding what investment actually is. Okay, so let's try to understand the basic. Let's try to understand um, the rudiments before we jump into something technical or something hard for us to discuss. Okay, so one, savings. Saving is, I mean, putting aside your money. Maybe you have an income, you have some earnings, and you would want to put some aside for for something else. Okay, and you don't have any reason, or you don't have any purpose of that money earning you some extra income or earning you some returns or profits or whatever. That is savings. So it can be at the bank, I mean, savings account. It can be in your room. It can be something that you deposit with a friend or a mom or a dad or a sibling, whoever. So it is just like putting your money safe somewhere without having any intention of growing the money. That is savings. Okay, so it is a store of value of your money. A store, you just put it at the store, I mean, to keep it safe. And then most of the time it has low or little income, all right, or returns, if I should put it that way. Little or no returns on that money that you put aside, because it is just savings. You don't have any intention of growing it. And then investment on the other side is you putting your money to work. Actually, you are giving your money a business to do, a function to perform. And the function to perform is you giving the money the chance to grow in itself, for you to have some returns or some profit or some um, growth in the value. Okay, so investment is putting the money to work with expectation of growth and acceptance of some risk. So whilst you put your money to work, you have to understand that you are also accepting some kind of risk, because you have the chance of losing the money or growing the money. So that is about investment. So while saving is putting your money to a storeroom to keep for a safe, investment is putting your money to work to give you some value addition, or to increase, or to have some growth. Now, another concept about investments, whilst we are talking about, is compound interest. Compound interest. That is the trick, or that is the magic, or that is the um, foundation of investments. I mean, talking about investment, the magic that works for investment purposes is what is compound interest, or compounding factor. Okay, so you put your money, let's say, into a business, or into I mean, buy shares, or anything, any investment vehicle for you to get a growth of the money. Now, the compounding interest factor is the idea that um, the returns that you get on the invested capital, you don't consume it, but you leave it with the capital, and then the capital plus the returns on that capital will yield another return for you, and it wouldn't be as the same as the initial capital that you put into the investment, but rather this one is going to increase in value for you. Okay, that is the compounding factor about investment, and that is the magic. That is um, the super idea or the super thing about investment. Okay, now let's also talk about assets and liabilities when we are talking about investment. So people have this idea that maybe I'm going to buy this, it becomes an investment for me. Meanwhile, that thing becomes rather a liability. I mean, because of maybe some attitude or some behavior or some kind of um, impact that thing is going to bring into your life. So assets and liabilities. So when we talk about assets, assets simply means something that brings you money, and then liability is about something that drains your money down. You understand? So that is asset. Anything that has the ability or capability to give you return, give you asset, give you money into your pocket is an asset. And anything that takes money away from you, that takes money off your pocket is what? Is a liability. So you can even have a car which you think, in your mind is an asset to you, but if the car is draining your pocket, is siphoning money from your pocket, it becomes a liability. You can have a phone, you can have a laptop, you can have buildings, whatever. They seem to be assets in its sense, but if they result or if they contribute to you losing money, it becomes a liability. But anything that brings you money in return becomes what? An asset. And then another concept about investment is return on investment. When we talk about return on investment, it's simply the money that you are getting on your investment. Okay, so you put in a capital of, let's say, 500 cities or $500 or whatever, and that $500 yields you maybe 100 cities or maybe 200 cities. That 200 cities or that 100 cities becomes the return on your investment. It's like a profit on business, or it's like um, earnings on your business that you invested in. So that is some basic concepts about um, investments. Okay, investments. So that is about it. Now let's jump into a very interesting part of investments for beginners. Actually, let's get to this important segment of investments for beginners. Now, we wouldn't advise anyone to just get up and go straight into, investment. Okay, say I have my money, you just get up, I want to start this, I want to put my money into this. No, hold on. Don't rush. Into investment. There are certain things that you have to go through. There are certain things that you have to know. There are certain things that you have to put in place before you have to venture into what? Investment. And we call it the pre-investment checklist. You have to meet all these checklists before you can have the bold step to what? To say I'm going to invest. That is about it. All right, so we have about say 5 checklists to meet before you would have to start investment. Now, first thing that you have to do is that you have to know your numbers. When I say know your numbers, what I mean is that you should be able to track your investment. Sorry, track your income and expenses. You are an individual. You get income, you get earnings, you get money into your pocket. Let's say you are employed, you do freelancing, you engage in some kind of active employment, and you get money into your pocket maybe at the end of particular period. All right, so you get income, and then you also spend. So that becomes your expenses. Now, as an individual trying to go into an investment venture, you'd have to track this income and then expenses of your life for at least 1 month. Know your income, the total amount of your income, know your total amount of your expenses, and then that will help you to know the savings that you have at the end of that period. Okay, so you can't just go into investment without you having this knowledge, this basic concept about your income flows and then your outflows. Okay, so before you start, please know your numbers, know the money that you are getting, and then know the expense that you are incurring at the end of a particular period before you try to go into what? Into investment. Number two, if you are a person who has a debt to settle or to pay off, try to make sure you pay it off. All right. If you have, especially those debts that comes with high interest, you would have to make an attempt or make every possible action to do it, to pay off such high debt interest first. Okay, so let's say you have um, a loan or a debt that accumulates or that yields, let's say 25% or 30% interest at the end of a particular period, and then you are going to invest, you realize that most of your income that comes into your hand will go into the debt servicing. So the the low capital and then the interest in addition, 30%, 25%, 15. I mean, so huge of an interest. So you have to make an attempt to make sure that you would settle that debt first, so that you become, financially burden free. Okay, financially burden free, so that you can have that peace of mind to um, go into investment full time. Okay, let me take this opportunity to recognize some of my participants over here. I think I'm having Joanna has joined. Joanna, welcome to this episode of Michael's Nugget podcast. We are discussing investments for beginners. So you are welcome to the show. Thank you very much for your time. All right.
Thank you.
Sure. All right. So another step, we have talked about the fact that before you start investing, know your numbers. You have to track your income and expenses. And then secondly, if you have a debt that you have not settled, you have not paid off, and then that debt is yielding high interest on your neck, you have to try and make an attempt to pay off such interest or such high debt off your books before you can go and then venture into investment. Now, number three is that you have to also build an emergency fund. You know that when you are investing, okay, investments, ideally takes a longer period of time for it to say mature or yield some kind of earnings for you. So if you are not so much careful, and then you go and put all your money in that investment, say you have gone to buy shares, or you have gone to buy bonds, or you have put your money into treasury bills, or you have put your money into a business setup, all right, or you have put your money into a real estate investment. You see, they take a longer period of time, and then they also involve huge capital, especially real estate investment and other high capital demand investment vehicles. And then you take the chunk of your money into these investment vehicles, and then you don't have any emergency fund built behind your back. You realize that when any emergency situation happen, you find yourself in hot waters. All right. So before you go into investment proper, try and then at least build an emergency fund behind your back. It serves as a financial cushion in times of any trouble. Death can come, accidents can come, you can lose your job. So having settled behind your back this financial cushion, when such situations come, you realize that you are okay, you are comfortable, you are not so troubled so much. All right. So before you start investment, we are advising, or we are suggesting that at least 3 to 6 months of living expenses savings must be set somewhere. Okay, so 3 to 6 months of living expenses in a liquid and easy accessible account. When we say liquid, like you should be able to easily convert that investment into cash, so that when you need it, you can just go and then grab it fast. All right. So these things are very important before you can even start what we call investment that we are talking about. And then the next step is that make sure you define your goals. What are the reasons why you are going to do investment? What are your investment goals? What are you going to use the money for? Is it for a short-term period? Is it for a medium-term period? Or is it for a long-term period? Are you going to invest so that in the near future you are going to use that money to build a house? Are you going to invest so that in the next few years you are going to use it to marry? This time marriage is it's a whole it's a whole business on its own. Like at least 30,000, 40,000, 50,000 cities. People are spending on marriages, which is so, to me, it's so much of a money that can be used for something alternatively proper, something beneficial, other than spending it so much on marriage. All right. Monies, if I should say it. All right. So define your goals. And that will help you to understand the timing of your investment. So whether you're going to invest for 1 year, 5 years or 10 years or 15 years. So when you define your goals, that will help you. Or are you saving or are you investing for retirement purposes? That is also another reason or another goal that you can set up for. So whichever goal, whichever reason or whichever purpose that you have for investing must be defined, must be outlined, must be understood, so that you have a clarity before you start what investment. You also have to understand your risk tolerance. Okay, because investment is all about risk. You can't talk about investment without talking about risk. Actually, risk is all over us. Whether high risk or whether low risk, it is risk. I mean, and people have their risk. Each individual has their risk tolerance level. Some can endure much risk, others cannot endure much risk. Okay, so you have to define what your risk tolerance level is before you can go into investment. So if you think that you can't um you can't stand the situation of you losing your money, please don't go into high risk investment vehicle. And if you can't stand the risk of your money losing its value, don't go for any high risk investment vehicle. Okay, you can think about maybe savings or treasury bills, or I mean the basic ones where I mean, even if when you lose your money you don't lose much, but people have high risk tolerance level that, oh come on, let me take 50,000, go and do lotto. Hey, 50,000 lotto permutation and all that, that is crazy. Let me use 50,000 for a bet or gambling. No, that is so high risk. All right, because your chance of winning, the probability is kind of low, right? So if you have um let's say you have like, let's say a lotto or bet or whatever. Let me use lotto in our terms. 100 numbers are going to be displayed, and then you are choosing two numbers out of 100. Your chance of winning is 2%, and this is crazy. All right, so you have to understand your risk tolerance level and before you start the investment. All right, so having understood this checklist, if you go through all these checklists and then you think that you check the boxes, every box is okay for you, you have, I mean, you know your numbers, you have paid off your high interest debt, you have an emergency fund built around you, you have defined your goals clearly, and then your risk tolerance level is also, I mean, understood, then you are good to go. All right, now let's talk about types of investments. Now we are going into investment proper. Let's talk about types of investments. All right, these are the various investment vehicles that um, we can suggest to our viewers and our listeners, and everyone that can hear of us, those investments that are available that you can put your money in. So one of them is stock or shares, popularly known stocks. And this shares and this stock that we are talking about gives you the chance to become a part owner of a company or of an institution. Okay, this stock helps you to, or gives you the chance to become a part owner. So let's say there's a company like MTN, I mean Vodafone, Ghana Commercial Bank, I mean, name them, all the companies around the world. They offer their shares on the stock exchange market, and then you go and buy, I mean, part or some of the shares. You going to buy the shares and then having investing in the company gives you the chance to become a part owner of the company. That is about it. So if the company grows, you are part of the company. If the company comes down, you are part of the company. Okay, so there are two things that we can talk about over here when we talk about shares in a company. So we are talking about, at the end of the period, the company may declare profit, and then out of the profit, the directors or the company management, they declare that, okay, we are going to um, declare this dividend for our shareholders. So at the end of the year, when they prepare their financial accounts and then they declare profit and then they declare dividends, that we are going to outlay this dividend to our shareholders, then you get a share or a part of the dividend declared. Okay, that becomes your profit or that becomes your returns or your earnings. And another thing is capital appreciation. So you buy a share of the company, and then over a period of time, the shares of that company increase in value. So let's say you bought the share at 5 cedis per share, and then at the end of the particular period, the share has a price of, let's say, 10 cedis. So you realize that your investment has grown from 5 cedis to 10 cedis per share. That is about it. So you get a chance to have a capital appreciation or a capital increase in value, and again a dividend declared at the end of the whole of the year. So these are the two things that are about stocks. Okay, and then the risk level is kind of from medium to high, if I should say, because the company can liquidate at any time. The company cannot perform. I mean, it can happen that they have low performance, and therefore they would even get profit. And even when they do get profit, um, there's nothing you can do. The value of the share can also reduce, and there's nothing you can do. So in that sense, you get a reduction in your investment. Okay, so that is about it. Now another investment vehicle is bonds. Another investment vehicle is bond, and this one is normally issued by government institutions or companies. Some companies also issue bond. This one is like you giving a loan to the company, so it's in the form of a loan. Okay, so at a point in time, the company will come out and say that we are issuing bonds. In other words, they are saying that they are borrowing from the public. They want to get loan from the public in the form of a bond. So you give them that money, or you go and buy the bond that they have issued, and then you become their creditor. All right, you become their creditor, and then they pay interest on your loan that you have given to them. I mean, in simple terms, that is how I can explain it. So that is about bond. Okay, so the company or the government institutions or government of a country can issue the bond, saying that I've issued the bond, I need people to come and buy the bonds. In other words, they are borrowing from the public. Okay, and then they also promise you that they are going to give you interest at the end of a particular period, let's say 6 months, or after 1 year they give you what? Interest. All right, and then at the end of the period, let's say you buy the bond for 5 years or 10 years, at the end of the period they give you back your money. That is about the bond. And because this bond is normally issued by governments or government institutions, this one has a low risk, or low to it has a low risk and a low return. So that is about it. Okay, that's about. But it is kind of secured in a way. The security is much high because it is the government that is issuing the bond. It's not individual companies which can just collapse at any time. But government, because they exist throughout the period, you feel that is a bit secured. Okay, yeah. And then another one is mutual funds or unit trust. Then let's talk about index fund and ETFs. So these are various investment vehicles. We can also talk about um, real estate. Real estate, that one is where you invest in, I mean, apartments or buildings where you get rental income, or you build and sell. And it mostly involves huge capital. That is about. So I think I mentioned about mutual funds. So mutual funds is also about a pool of money from many investors that is managed by professional fund managers. Okay, that is managed by professional fund managers. So that is about you get this investment vehicle, and then a lot of like people bringing their money from elsewhere, and then they put it in a particular pool, and then this pool of money is being managed by some professionals, and then when it yields some returns, you get your share of the returns. Okay, and then ETFs also tracks an entire market index. So for example, S&P 500 and what have you. So instead of you picking one company, you realize that you are buying, or you are having a slice of hundreds of companies, different companies, built in diversification. Okay, that is about the index fund. So I mean, there are fees. I mean, that is attributed to you investing in what, in index fund. So you invest in one particular, let's say S&P 500, and then you get a chance to have own a slice of hundreds of companies. You understand? So that is about the index fund and then ETFs. Now, let's sign this warning. If you are a beginner, like we are trying to let you people understand. If you are a beginner, there are certain things or there are some investment vehicles that you should try to avoid at the beginning stage because they are highly volatile. They are highly speculative. For example, crypto. If you are a beginner, you have not tested investment before, you have not done anything about investment, and you are now trying to start. The advice is that these investment vehicles are very volatile. When we say volatile, like they 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 are not so much static. The value increases, changes anytime. So okay, so very often. Okay, and then they're also speculative in nature. All right, so it is not an ideal starting point for a beginner. You have to learn the fundamentals first. It is important for you to learn the basics. All right, learn the basics before you can go into this kind of investment vehicles. Okay, this cryptocurrency, it is kind of, I mean a good investment vehicle though, but because you are a beginner and then you have not um you don't have much knowledge in investing, you have to understand it first. Get some expert to teach you some certain things before you can what you can get into it. All right, those of us who have joined us on YouTube, you are welcome um to the show. Thank you for your time. All right, so we are discussing investment for beginners. That is our discussion topic, and we are trying to explain things that if you have not done any investment before, you would have to understand before you put your money into anything else. Now, let's talk about risk diversification and time. We cannot talk about investment without talking about risk. I made mention earlier on that investment comes with risk. Okay, you going to put your money into something else to bring you money. It's a risk that you are taking. It is possible that the money that you are putting in, you can lose the value or you can lose the the money entirely. So it is a game of risk. Okay. Now it is not something also to avoid at all because you cannot avoid the risk, but you can manage and then you can what? You can reduce it. Okay. And then risk is the price of your return. So you getting the money in return of your invested capital, the risk is also, alongside. So when the risk come, don't be surprised because it is part of the investment fraternity. Okay. Now, any investment that comes with high return or high profit has high risk. That is the basic rule. Yeah, you have high returns, definitely you would have high risk. Okay. And again, if it has low returns, like say low profit, you have to understand that your risk is also what? Is also low. So for example, if you go and put your money in a savings account, savings account though don't give much interest, all right, because the the risk is very low, and because of that, you are not going to have high returns. That is about it. Okay, all right. So that is about the and then diversification. Diversification is the underlining topic under the mantra. Don't put all your eggs or your raw eggs in one basket. So if you are going into any investment, don't put all the money that you have into one particular area of investment. So let's say you are going to buy shares of MTN company, and all your life savings you have taken it in lump sum, you are going to invest in MTN. I mean, for example, right? And then eventually MTN collapses. What is going to happen to your money? You are going to lose all your money, right? So that is about diversification. So diversification is a concept or it's a principle that don't put that money that you are going to invest into only one company or into only one thing. So spread it across. So let's say a bit in MTN, a bit in business, a bit in real estate, a bit in maybe bank savings account, a bit in land property. So you realize that if this place even collapses, there is a cushion somewhere. Or if this place doesn't perform very well to your satisfaction, This one is going to what? Cushion you up. So you realize that you have leverage on your risk and on your returns. You understand? You have leverage on your risk and on your returns. That is about what? Diversification. Don't put all your raw eggs in one basket. You have to spread across all asset types and then across different sectors, across geographies. When you say sectors, I mean, let's say you invest in tech industry, you invest in health industry, you invest in agricultural industry, you invest in something else industry. So if this industry or if this sector doesn't perform well, this sector is also performing well. And then when you say asset types, so asset types, maybe you want to sell cars is one asset, I mean type. You want to sell land is one asset type. You want to sell laptops and phones is one asset type. You want to go into real estate buildings, one asset type. So if real estate doesn't perform or this, I mean building doesn't perform, you realize that land is also there for you. You realize that your cars is also there for you. So that is about what assets or types. And then again, geographies. When you say geography, it's about location. So let's say you have an investment in, let's say, Takrade, Kumasi, Accra, Kaswa, across various geographies. When we go international or global, we can talk about the fact that we are investing in Ghana, we are investing in America, we are investing in Dubai, we are investing in Turkey. So across geographies, that is about location wise. So if Ghana economy collapses, US economy is still standing. If US economy collapses, Dubai economy is still standing. If Dubai economy collapses, Europe is still standing. So you diversify your investment across different geographies, different locations, so that if one location is underperforming, another location is what overperforming. So you get a balance. That is about what diversification. And then let's understand that as a beginner, diversification wouldn't eliminate all the risk, but it will manage it. It will reduce the risk to a barest minimum. Okay. So don't think that you spreading across your investment over different sectors, different geographies, different locations, different asset types is going to remove all the risks. No, that is not the idea. So it's going to reduce to a manageable level for you. That is about the diversification. Now, how do we actually get started when it comes to investment? Let's talk about it. How do we actually get started? Step by step action plan. Step by step action plan before you actually start investing. Now, like I said earlier, don't wake up, don't get up and say, I am going to invest. There are things that you have to follow. There are steps that you have to follow. First of all, you have to understand basic financial knowledge. Okay? Understand what you are going to do. Because if you don't understand what you are even doing, you know how, you know that yes, someone has told me I want to go and invest. Someone has said that investment is very good. Someone has advised that I have to save for the future, I have to put my money down, I don't have to consume my money. Okay, fine. That is perfect. You want to start something. You then just wake up and say, because Michael said it, because this person said it, I'm going to do it. No, hold on. You have to understand what you are going to do. Get some basic financial knowledge, like we are trying to, I mean, get our public on. Okay, we are trying to get our public on. So complete your financial foundation, get some financial knowledge, understand savings, understand investment, understand retirement, understand financial planning, basic knowledge. You don't have to enroll in financial accounting class or investment accounting class or whatever, no, but basic. This time knowledge abounds. YouTube is there, you can just click on basic financial knowledge. Various AI tools are all over the place. You can just input the prompt and then they give you some knowledge that you can just make good use of. Okay, so that is about it. Understand basic financial concepts. And then number two is that, and then go and then choose an account type. What account type that you do want to invest in? Is it about pension, retirement, or is it about school plan? What type do you want? So once you have understood the basic financial knowledge, then you move on and then go in for your the account type that you want. So pension is there, retirement is there, I mean school funding is there, whatever thing that you want to talk about, whatever account that you want to choose, you can talk to the expert there, and then they can what they can. I mean, talk about it. We have a regular brokerage account, unit trust, that will match your investment goal, the goal that you have defined. That will match it perfectly what for you. And then the next step is that you have to pick a platform or institution to to be a middleman for you, because you can't just get up and then go and buy or go and invest in a company, or go and buy bond or shares. No, there are always some financial institutions that are in the middle point that they can transact for you. You can't just go to the stock exchange market to go and say you are going to invest. Okay, sometimes you have to go to an expert or some institutions that are there for you to do the buying and then the selling for you, buying the shares or whatever. So that is about it. So you can look for the regulations that are involved. You can talk about the fees that are involved, and then you also talk about user friendly interfaces. If you want to do a research, both local and then global options. Okay, so for Ghanaians, we have companies that are there for us to go and then talk to them for investment purposes. We can have Carl Asset Management. We also have Data Bank. I guess you guys know Data Bank. And then we also have a public investment. And then globally too, we have Bamboo. We also have RiseVest, and then we have Charles Schwab, and then a host of them. So after you having the basic knowledge, choosing an account, then you have to pick your institution that you can rely on them to do the investment for you, or you buy the shares for you, or make the investment for you. And then the next step is that you have to start simple. Start simple.
Right. Oh, it's so.
Hi, Fred.
I take accountability for this. Hey, Mike.
Yeah, senior. I want to recognize your presence.
Oh, has the meeting ended already?
No. We have few minutes to end.
Okay.
We are still ongoing.
Oh, okay. Thank you.
Yeah, thank you very much for joining. I appreciate your time.
You're welcome.
Yes, sir. All right. So we are discussing investments for beginners. If you are a beginner and then you are trying to invest, what you are supposed to do, what are the things that you are supposed to, go about. That is what we are discussing tonight. Okay, so guys, those of us on Zoom, let me say that we have few minutes to end because our access time to Zoom is limited. So I will kindly ask you to join from YouTube if you can do that, because I sent the YouTube link as well to you guys. So kindly join from YouTube for me. We are live on YouTube as well. Zoom has few minutes to left to end. So please kindly do that for me. Thank you very much. All right. So after going through all these steps, the next step is that you have to start simple. Don't rush into investment, okay? Because it is risk and return game. If you don't do it carefully, you are going to incur a lot of risk on yourself, and you are going to lose your money. So you have to start simple. Because you are a beginner, a diversified low cost index fund, or a balanced mutual fund, or a basic um investment vehicle will be a good start. Okay, it will be a good start, and then from there you start building your investment blocks small by small, bit by bit, and then your portfolio, you begin to add more portfolios to what you have already. Okay, that is about it. And then again, don't exercise panic, or don't exercise obsession that almost every now and then you are going to check your investment. Every now and then, hey, how is it faring? Those kind of things. Don't be so obsessed with the investment. Take it easy. But you can periodically review, check your portfolio, check your investments that you have made. How is it going? Is it growing? Is it reduced? Because if you are so obsessed about your investment attempt that you have made, you realize that you begin to be panicking, you begin to be thinking that, hey, Mr. K, am I losing my money? And then you realize that that is not a good um, emotional situation for you as a beginner trying to do what investment. That is not a good thing to do. Okay, so don't be so obsessed, but rather take your time, review. Is it going good? Is it going bad? What are the things that am I supposed to do, put in place? And then you would understand it better. I mean, whilst you go through. Now, let's talk about some biggest beginner mistakes. Most of the time, these are mistakes that those of us that we are starting to invest, we do. Okay, those of us that we are starting to invest, we do. But this is a mistake that we should try as much as possible to avoid when you are a beginner trying to start with investing. Okay, now one mistake that we are supposed to avoid is emotional investing. Emotional investing. We are emotional beings, no two ways about that. Okay, but um people, immediately you hear this thing, you hear this investment thing, I'm going to invest. Immediately you hear this, I'm going to invest. No, no, you don't do, you don't, you can't be emotional like that, please. You are so excited, like, okay, yeah, then you just pick up and then you go. No, 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 that's not how you invest. So those of us who are into shares or who are into this kind of bonds or whatever, let me say shares. Okay, so immediately they I mean, they hear that prices has reduced, then they go in fast to buy. They are going to buy the share because prices have gone down. Like, let's say, I mean, dollars. Those of us who are into forex or forex exchange, when they hear dollar has gone down, then they are going to buy the dollars because they think that dollar will rise again, and then they can sell, and then they can get their money, and they can get some profit. You can't be so, I mean, emotional about this kind of investment. Okay, so you have to take your time, study the market a bit, understand the kind of investment that the person is talking about before you go in. Don't be so emotional. Don't I mean, be a man. Be analytical. Be proactive, be analytical, understand what you are going to do before you go into this kind of investment that you're talking about. And another mistake is that people also chase past performance. People chase past performance. When we say past performance, we are saying that, okay, I have invested in MTN, I've invested in CocoBoard. Last year, CocoBoard had a profit of, let's say, 200%, or they had increase in profit of 200%. So they think that because in the past, CocoBoard has earned a lot of profit, this year too, they are going to earn the same thing. That is not correct. I mean, that may not be correct. Okay, so an increase in profit last year doesn't mean that it's going to be the same this year. Situations can change, things can overturn, things can turn around. Okay, so you have to sit down and then know the pattern. Okay, know the pattern first, understand their record, understand their pattern before you go and then do the investment. Okay, so that's about it. And don't listen to hearsays like, oh, we ye say last year, so me quite this thing did last year, so I mean, I want to go and then invest. No, take your time. All right, and then um understand it. And then another mistake is that falling for get rich quick scheme. We call it Ponzi scheme. All right. We often hear that people will come and invest, come and do this, and we are going to have um, a profit return of, let's say, 50% within 2 weeks or within 1 month. Come on, this is a purely Ponzi scheme manipulation. Okay, this is purely Ponzi scheme manipulation. So, like, we can talk about, is it number one situation? All right, the one that we experienced in Ghana some years back. Okay, an investment that is promising you huge returns within a short period of time can be a get rich quick scheme, which will eventually cause you to lose your money. All right, which will eventually cause you to lose your money. Okay, so don't fall flat for such, I mean, manipulations. All right, so that is a mistake that you are supposed to what you are supposed to watch. All right, so let's also talk about you not also reviewing your situations. Okay, so another mistake that people so often commit is the fact that they don't review their investment. Okay, so whilst you are growing, and then you realize that your goals may be changing or maybe shifting, so you have to also adjust. All right, so you have to adjust your goals. I mean, whilst you are aging, because you being a young person, your goals may be different from you being a married person or a grown-up person. You have to understand the dynamics. Okay, so a 25-year-old person wouldn't be having goals as the same as a 60-year-old person, or wouldn't have the same portfolio as a 60-year-old, because your time range are different, your goals are different, your purpose are different. That you have to understand it. Okay, now these mistakes, whilst you are a beginner, are bound to happen. No matter what, you have to be honest. Most of us will make some of these mistakes. Okay, most of us will make some of these mistakes. We have to be honest with ourselves. Most of us will make some of these mistakes, especially a mistake of saying that I want to wait for the right time for me to invest. I want to wait for the right time for me to what? For me to invest. Okay, and the reality is that there is nothing like a perfect time, and the best time is today, or probably the best time was yesterday, and then if it's past, the best time is what? Today. The second best time is today. You have to understand that. Okay, you have to understand that there is no a perfect time. If you have failed to invest, or you have failed to do the needful in the previous days, or in the previous years, or in the previous period, today is the perfect time. Start small, start with what you have right now, and then start at where you are right now, and then lo and behold, before you realize, your investment has grown. Okay, your investment has grown, and you can't wait for another time. You can't wait for another time for you to start investing, because you being a young person, you being a beginner, no one knows tomorrow. Anything can happen. All right, there should be a plan for your life. There should be an arrangement for your life. That what if so and so happens the next day? What am I going to do again? All right, so you can lose your job, you can become disabled, that you are not so much active to work or whatever. But when these things are in place, you have invested very well, you have money behind your back that is cushioning you in days of emergencies, then you will be fine, you are okay, and then things will work perfectly for you. All right, now let's bring everything together. So we are saying that investing is not about you being rich. Okay, investment is not about you being rich, or you being smart, or having the right connection. That is not about investing. Okay, investment is about you starting today, and then starting with the little that you even what have. Okay, now you can track this presentation, and then you realize that most of the things that I'm talking about probably may not be relatable to you, or maybe of technical to you, or maybe of high level for you. But there are basic investment things that you can do. All right, so you can engage in business, you can engage in trading. All right, and then one major investment is even in your mindset, your I mean growth, financial knowledge, and then knowledge in general. That is also a huge investment. And another investment which is very critical is investment in your health. I mean your well-being. Okay, so you can start with anything, you can start at anywhere, you can start whenever that you would have to what start. So it is all about starting, and then not stopping. You being consistent with the investment, I mean vision that you have. Okay, that is about it. Now you also have to understand inflation. Okay, because if you have money today, um and then the money is not growing, the money is there in itself. It is the value of the money is there in itself. And then you also have to understand that inflation causes money to lose its value. You have to understand that inflation causes money to what? To lose its value. So that is the beauty of even investment, because investing your money or investing your capital will help you to overcome the challenge of what? Inflation in your economy or in your jurisdiction of operation. Okay, so you invest the money, and then the returns on your investment will overshadow what the inflationary situation that you have in your in your economy or in your country of operation. And then another magic about investment is that there is also a power of compounding or compounding interest, which rewards you over time, which gives you reward over time. Okay, that is the magic of investment. And then if you don't have patience enough, you would think that, or you wouldn't get the full benefit of compounding, because investments, everything about investments, the magic about investments is compounding. You invest, you get return, you don't consume the return, you add it to the initial capital, and then both investments and then the returns will you do additional what additional return, which is higher than even the previous one that you had, and then it builds up. So before you realize, your money has increased in value exponentially. Your money has increased in value exponentially. That is about it. So it is not about, it's all about starting and not stopping, and then you understanding that investment is a solution toward inflation. That is about it. And then how compound interest also rewards your time. And then the main asset types and where beginners should start, we have also learned about that. We have discussed that. So that is a call to action, that you'd have to make investments your priority at all costs. Make investment your priority at all costs. All right. So that is a call to action. Then you have everything that you need to make a first move. So I have a question on YouTube. I want to address it. Daniel is asking, please, the investment with these highly reputable institutions, are they going to consider our capital regardless of their investment plan? So if I should understand your question, um, are you talking about the fact that maybe they may demand high capital at the start? Maybe if I should put it that way. So yes, so let's talk about, let's say, we mentioned MTN, we mentioned Ghana Commercial Bank, we mentioned Cocoa Board, and those gurus. Yeah, capital, the shares that they are selling, most of them they sell it, let's say 10 cedis per share or 5 cedis per share. All right, so most of them, their shares don't have high price. Okay, their shares don't have very high prices. Okay, as little as 5 cedis, 10 cedis, 15 cedis, 20 cedis, you can buy some of their shares. So there, yes, so like I'm trying to explain, most of them, they have their shares priced at, let's say, 10 cedis per share, 20 cedis per share, 15 cedis per share, 30 cedis per share. So I mean, one share, you're going to buy one share, but for you to get benefits or for you to get high returns on the shares, that is where you have to buy maybe 1,000 shares or 2,000 shares because you want to get high returns. So for example, if they are at the end of the year, they are giving dividend per share of, let's say, 20 pesos, you realize that the whole year, because you have bought one share for 20 cedis, and then they are giving you a profit percent, or let's say a dividend per share of 20 pesos, you are going to get 20 pesos on your 20 cedis share that you have in your company. So for you to get that high huge of return, let's say you have 10,000 shares in the account, and then they are giving you 20%, sorry, 20 pesos on that per share, 20 pesos per share. So you multiply your 10,000 shares that you have in that company, and then you get the amount of your returns on that company, from that company. Okay, so these companies, even though they are, I mean, they are strong in the industry, they are highly reputable, but some of the shares, they come with low share prices. You can buy them at low prices. Okay, yeah. So, and one other thing is that sometimes they have a minimum number of shares that you can buy. So let's say you can't just buy only one share. So a minimum shares of, let's say, 100 or 50 or 200. You understand? So that means that you can't just buy one share of 20 pesos, 20 cedis. So you have to the minimum share that you can buy 100 shares multiplied by the 20 CDs or 10 CDs or 5 CDs, then that becomes your start your investment. I hope I answered your question, Daniel. So that is about it. Thank you very much. Yeah. And then so not only these companies, but in your own small way, you can also make some investment. So um you can start a Momo business which requires not so much of capital. You can start some trading, which probably you can also start with as little as, let's say, 100 or 200 CDs. Yeah, you can start these online businesses. You get some sellers or some sneakers. You just advertise on your social media handles. People come to buy, and then you still reinvest the money. So these are things that you can do. So investment comes across, I mean, a whole lot of ranges. Not only about these companies that I've mentioned their names, but you can start something small at your corner that can yield you some sort of returns. Okay. All right. You can also, I mean, enter into high risk venture of, let's say, giving your money out out as loans to your friends. Then they will give you interest at the end of the period. So if you have, let's say, some 500 cities or 1,000 cities, people need money for agent use or agent purposes. You loan it to them, and then you charge them, let's say, 10% per month. And then when the month is due, you get your money back, and with the interest. That is also something that you can start, and then gradually. But that is, I mean, high risk. Something people take your money and they don't even bring it back. That is about it. So if I answered your question, Daniel, I think you can let me know about it. Yeah. So let's give our listeners or our viewers some call to action. I want you to take a step. This week, I want you to track your expenses, track your income. Just observe, don't judge. Don't kill yourself. Don't think that you are doing so bad. No, because maybe you are now navigating your way out. So don't kill yourself. Just navigate. Just observe. Just track. Know the amount of money that is coming into your hands every month, every week, every period of time, and then sit down to also track your expenses. I'm giving you this week to do that. I mean, my listeners and then my viewers. So track your expense, and then by the end of the day, you know whether you are you are at a savings point, or you are at a loss point. All right. Ismail is asking, is there a platform or app for buying these shares? Yes, very true. There are. You can't get up and then go and buy shares by yourself. No, there are companies that serve as intermediaries. Okay. There are companies that serve as intermediaries. So, for example, DataBank is one of the companies that you can go to for them to buy the shares for you. You can't buy the shares your own. Okay. And then when you go to their website, I think I made mention of some of the companies. So let me go back to some of these companies and then mention them to you. So we have DataBank is one of the companies that, or one of the platforms that you can go to for them to buy the shares for you. Car Asset Management is also one of the companies. Republic Investment is also one of the companies. Okay. And if you want to also go globally, maybe you want to buy shares in America, in Europe, in Canada, Australia, whatever. You want to, I mean, extend your investment portfolio. We have global businesses or global platforms that you can talk about. We have Bamboo, we have RiseVest, we have Charles Schwab, and most of them. Okay, so um that is about it. Ismail, I think I answered your question. So you can't individually, you can't just go in and buy the shares. You have to go through these companies. Okay. Or you can also go to um Ghana Stock Exchange website. They have a list of all the companies that are registered and licensed to trading these shares. Ghana Stock Exchange. When you go to their website, there is a tall list of Ghanaian companies that are licensed and um, authorized to trading. I mean, shares, buying and selling of shares. We call them brokers or brokerage firms. Okay, so that is about it. All right, thank you very much. So, like I was saying, I want to give you a call to action. So this week, I want you to take time, track your expenses, and track your income. Some of us, I can bet you that someone said that Ghana we are magicians, because when we compute the expenses that we incur, and then when we compare it with the income that comes into our hands, we are living in a magic world. Someone said it somewhere or one of the social media channels that Ghanaians are magicians. Yeah, it's true, because when you sit down to track, you realize that your expenses are so much higher than your income. So assuming that you are earning an amount of 1,000 cedis every month, I mean, let's take into perspective. You are doing your national service, you have started unemployment, and then you are earning 1,500 cedis. So, and assuming also that every day, so let's say every morning you spend 30 cedis, afternoon 30 cedis, evening 30 cedis. So you are spending 90 cedis on your own food, on consumption. So 90 cedis times 30 days, that's going to give you 900 cedis. All right. TNT is not part of this expenditure. Data is not part of this expenditure. Your nibbies, I mean your sneakers, and then shaders are not part of this expenditure. Your wardrobe, let's say your wardrobe is not part of this expenditure. Your toiletries and what have you is not part of this expenditure. Your parents, your siblings, maybe they are relying on you. They are not all part of this this expenditure. All right. Come on, 1,000 cedis is not much for you to rely on for a period of even a month. Prepaid has not even come. I mean, talk about it. Prepaid has not even come. So let's sit down and track all these expenses, and then you realize that you are going overboard even of your income. And then you also have to this month, let's say take another month, and then confirm your emergency fund status, and then research into investment platform available in your country. So Ishmael, I think this is where we are coming to your question. So take a month. If you are a beginner and you want to start investment, confirm your emergency fund. So we have said that, or we mentioned earlier, that you can't start investment without having a backbone or a cushion, financial cushion behind your back. Make sure that you have at least 3 to 6 months of emergency fund sitting somewhere, in case when you lose your money in the investment, you can fall on something that can sustain you for a while. So at least 3 to 6 months, and then again take that month to also research the investment platform available in your country. So like I said, the very basic platform that you can get all this information is Ghana Stock Exchange Market or their website. Every information is there. I have their PDF. I can send it across in the broadcast list, and then you can also, um, look at it. Take a look at it, and then you read something for yourself. And then take 3 months, open an account, and then make your first tiny investment. So steady, steady, and then just take a step. Boom. Let me try and then see. Now, you can't sit down and then be researching the whole year. No. You can research everything that you want to research. You can read everything that you want to read. Without a step, without action, you are still at your position. Okay? So kindly make a step, make a bold step. Start investing into something. Start investing into something. Don't wait till you get enough money, because human needs are insatiable. Those of you who read economics, you can tell me that human needs are insatiable. Like, you don't have an end to human needs. Every day there is a need. Every day there is a need. But if you take a bold step and then start something, you can you see the benefits of it. Now, I want to sign off. Those of us watching me live on YouTube, I want to sign off. You can put your question in the chat, and then I can address it for you. Whatever contribution, whatever thing that you also want to talk about, we are here, we are listening. We are now building um the channel, we are now building the platform. We are asking you guys to contribute to the success of the platform. Whatever thing that you think that will help the platform work better for us, to grow much bigger, you can contribute. You can say it in the chat box, and then we can all have very nice interaction. So let me sign up. I'm saying that money is a tool. Okay, like I discussed last week, money is a tool. It can make you or it cannot make you. Okay, depending on how you're going to put it into use. Okay, And investing is how you make the two work for you while you sleep. Okay, investment money is there in itself. It's like a working tool, but investment is you putting the money into work or putting that tool into work. So you put the money into something and the money is working for you. One thing that you want to I want you to get into your mind is that anytime you get money into your hands, tell yourself that let me put this money into use, let this money work for me to get money. In that sense, you realize that you sit at your one place and then the money is earning for you. You don't bother yourself that much, and then you are good to go. You don't need to also get a finance degree. You don't need to get a finance degree to start investing. All right, you don't need a finance degree to start investing. You need not to enroll in a degree course uh, before you can start investing. Okay, so um you just need to start, and then when you start, you have to be consistent. You have to be consistent, never give up, never fall down, never fall off. Be consistent, and then give it the time. Investment needs patience. If you are not that patient enough, you will give up, because investment is so much dynamic, so much volatile. If you are not so patient enough, you are going to give up. Okay, and today is the day, today is the time. Don't wait till any other time, and don't think that you want to have to get a lot of money before you start something. All right, so like I said, I'm signing off. I hope this um episode helped you a lot. Those of us who have stayed on till the end of the period, I appreciate your time. Ismail, thank you very much. Daniel, God bless you, and Steven too. God bless you guys for staying on the channel for me. All right, now let me suggest to you some books that you can read. Let me suggest to you some books that you can read. That I've gone through these books, and then it can help a lot. So one of them is Psychology of Money. It's a very good book, very nice book, Psychology of Money. And then Rich Dad Poor Dad. That is also a very good book that you can read. And then another book is I Will Teach You How to Be Rich. I Will Teach You How to Be Rich. It's also one of the finance books, or one of the investment knowledge books that you can find to read. You can Google, you can search on Chat GPT to help you out. All right. So these are the books that I will recommend to you. And then, like I said, you can also go to Securities and Exchange Commission, Ghana Securities and Exchange Commission, to also read a lot more about what investment. Guys, thank you. I appreciate your time. I appreciate your contribution. If you have questions, you can ask. If you have any contribution, if you have anything that you want to share with me, I will welcome it very much. And Ismail, if you are still with us, you can contribute to the program. Daniel, if you are still with us, any contribution is welcome. All right, so thank you very much. And I'll okay, so hold on for a while. Let me get the PDF file for you guys. I think Ismail wanted to get it. Let me see if I can get it for him. All right, so I have it here. Let me forward it to you guys. You can have it. Okay, no, okay, you let me put it on the chat, and then you can have it, Ismail, so if you can hear me. So guys, thank you very much. This is the end of live streaming on YouTube, and hope to catch you next week, the same time, with a different topic to discuss. And I think next we are going to have a guest on the show all the way from the USA, who is going to join us, and then we are going to do some discussions on the episode. Thank you guys, and have a very good night. God bless you.